Welcome to ACY Securities. I'm Ira Reyes, macroeconomic strategist. Wall Street faces a high-stakes gauntlet this week as a mega-cap tech earnings critical central bank decisions from the Fed and Bank of England. Plus, there is a cost-push inflation in relevance to the inflation that collides to test the global market momentum. Let's have a breakdown of the interest and inflation and the gold today. Just a reminder, this represents my personal view of market movements and does not constitute investment advice. Trading involves a high degree of risk. Please ensure you have a solid risk management strategy in place. My strategic analysis is I utilize a dual-layered approach that synthesizes macro-level catalysts with technical precision. And by cross-referencing fundamental shifts against statistical trends, I execute high-conviction trades where market sentiment meets optimized expectancy. So before we start, please don't forget to like, share, and subscribe to our channel. And for further information about in-depth analysis, you can join our discussion on Discord. The link is on the description box below.
Disruptions have also caused international oil prices to drop by more than 5%. Meanwhile, we see American consumers are continuing to feel the pinch as domestic gas prices tick higher. So we also have earnings week schedule. So today, let's take a look.
So on Tuesday, we have the industrial stalwarts and we have the consumer staples that would kick things off. So featuring, we have updates from Boeing, Coca-Cola, and Ford. And on the midweek, from Wednesday and Thursday as well, so we have the mega cap tech that takes the center stage. So starting, we have the Microsoft and Meta on Wednesday, followed by Apple and Amazon on Thursday. And the later week, on Friday, so the schedule wraps up with energy heavyweights like Chevron and ExxonMobil, alongside the healthcare reports from Moderna and consumer goods updates from Colgate-Palmolive. Now, recent corporate developments include also the DeepSeek suspending as well its latest funding round, while the NVIDIA discussing as well a massive guarantee for an open AI data center lease and investing in Never. And we also have the Samsung winning a large chip contract from Broadcom and Qualcomm as well planning double-digit price increases. Now, having all these reports this coming week, since we're on the peak of the second quarter, so why this matters? So Wall Street intensely focuses on this heavy cluster of reports, and together their financial results and forward guidance act as a crucial economic barometer for the broader economy, and also providing critical insight into consumer spending habits, corporate tech budgets, and overall the market momentum. So again, you can take a look as well on the time frame once the New York session trade opens. So global markets experience a calm weekend, and there is also a pause in the Middle East conflict. lowered oil prices, and also it boosted the stocks. Meanwhile, we've seen as well the Nvidia and the SK Hynix announce a massive memory deal projected to reach up to $500 billion. So this week is really shaping up to be one of the heaviest and most critical stretches of the corporate earnings season. And also from mega cap tech giants spending billions on AI to automotive, retail, energy, and healthcare leaders. So Wall Street is about to get a massive check on the global economy. So let's break down the exact stock earnings reports you need to watch, what to look for, and the core questions investors are asking right now. And we have to take a look at this one, not because it's just only the second quarter earnings report, but rather they are dragging or they have the weight of the indices. So first up, we look on the heavyweight tech sector. We'll start with the Microsoft. So what to watch? The Azure cloud growth and the commercial monetization of the AI services. So the big question here, so are enterprise customers increasing spending on the Microsoft's AI stack fast enough, to justify the massive capital expenditures or the capex? And also, Wall Street will scan guidance for intelligent cloud segment very closely. Next, we have the Meta platforms. So what we need to watch here is the digital ad or digital advertising demand, and also the core user engagement across Instagram and Facebook. So the big question is, Meta's heavy spending on AI infrastructure has investors asking when to do these data center outlays translate directly to bottom line returns. So we have to watch out for any revisions to full year of the capital expenditure. Now moving to Amazon. So the Amazon Web Services or the AWS growth rate alongside the e-commerce retail margins. So can the Amazon Web Services accelerate its cloud momentum to match their competitors? Plus, at the same time, investors will also look at retail margins as a gauge for consumer spending habits. Again, Amazon is really having a big demand, particularly during inflation and interest rate. So we need to take a look on the performance of the Amazon once the interest rate decision and even prior to the decision date. Now, rounding out the big tech is we have the Apple. So what to watch here is that iPhone upgrade cycles and the services revenue from the App Store and iCloud, and also the consumer demand trends in Greater China. So here, the big question is, are there early signs of strong consumer appetite for Apple's latest hardware that features and also the AI integration initiatives? Now, going to industrial sector, we have the aerospace and consumer staples. First, we take a look at the Boeing. So, commercial aircraft delivery numbers, that's what we need to watch. Plus the manufacturing quality controls and also the FCF or the free cash flow burn. Now, the big question is the aerospace giant finally stabilizing its production lines and also ramping up plane deliveries to major airlines? And another is we have the Ford. So what to watch here is profitability in traditional gas-powered vehicles. So here you can see, and at the same time versus the losses in the Model E electric vehicle division plus dealer inventory levels. Now, in the consumer staples, of course, we have on that aisle is the Coca-Cola and Colgate-Palmolive. So what to watch? So pricing power versus the actual volume growth. So here, are shoppers still absorbing higher everyday prices for household goods, or still a persistent inflation pressures pushing them toward cheaper store brands? So that's how we look on the metrics of these stocks. Another is for the oil titans. We have the Chevron and ExxonMobil. So what to watch here? If there is an upstream production volumes, refining margins, and also shareholder returns through dividends and share buybacks. So the question is, how are these energy giants navigating fluctuating crude oil prices and complex global supply dynamics? And lastly, in the biotech, we have the Moderna. So what to watch here? So vaccine demand updates and progress on non-COVID pipelines like the RSV and cancer vaccines, and also the cash burn management. Now, can the Moderna successfully transition past declining pandemic era, the revenue into a thriving commercial biotech portfolio? So that's the highlight of what we are going to look on the earnings report this week. So we also have the tensions between the US and Iran continue to fuel global inflation fears and also drive up energy prices during these ongoing military strikes. Plus, the US business activity expanded this month, July. So we have to kudos to the strong service sector, even as supply chain pressures also intensified. Now, the Wall Street closed mixed last week as investors as well, they weighed on corporate earnings and also they monitored the likelihood of future interest rate hikes. So let's take a look. We have here. So here, they weighed on the corporate earnings and even the supply chain pressures, it also intensified. And also they monitored the likelihood of future interest rate hikes. Plus, we have the European market. So last week, they finished higher and it was led by strong corporate reports and also a recovery in business activity across Germany and the United Kingdom. Plus, the crude oil prices, they pulled back slightly and following the reports of potential diplomatic talks, which is until now we're waiting, though the weekly gains also remained elevated. Now, markets are now bracing for a busy week. So we have the central bank's policy decisions from the Fed, the Bank of England, and Bank of Japan. Plus, meanwhile, we see also a softer Canadian inflation data that ease expectations for further domestic rate hikes and stabilizing the currency near 1.41 per US dollar. Another thing that we have to take a look as well on the tariffs. So the US president has announced new tariffs ranging from 10% to 12.5% on 60 trading partners. So utilizing there is a different legal framework under the Section 301 to make the import taxes a permanent feature of US policy. Unlike those previous temporary measures, so these duties arrive during a more fragile global economic climate and marked by ongoing Middle East conflicts and energy shocks. So again, we are warned that closing legal loopholes make these tariffs a lasting structural lag and drag on global growth and also raises the risk of future interest rate hikes. Now, we take a look on the calendar this week. So again, you can see as well, we have high impact data, particularly on inflation and GDP and interest rate. So let's begin with China. We have the Politburo meeting. So this is a top-level political meeting where leaders discuss and set major economic policy directions and also the stimulus plans. And they also have the NBS, manufacturing, PMI, that will be on Friday. So it measures as well the factory activity and a number above 50 because they have a forecast of 49.9. So a number above 50 means growth, while below 50 signals a slowdown. So previous was 50.3 and now they have a forecast of 49.9. And for the Germany and the Euro area, we have the GDP growth coming on Thursday. So it measures as well the quarterly and the yearly economic output to show how fast or slow the economy is expanding. And for the inflation rate, both for Germany and the Eurozone. So this is coming Thursday as well. And on Friday, so it tracks consumer price acceleration. So higher inflation can influence the central banks to keep their rates restrictive. Plus, from the United States, we have a couple of economic data. We have the durable goods. So here, and the press conference in the midweek of Thursday. So the US Fed decides on interest rates. So currently we're tracking around 3.75%. So with the press conference offering forward guidance on rate paths, plus we have also the GDP growth and consumer data that will be on Thursday. So these key snapshots, including advanced second quarter GDP, personal spending, and the core PCE price index, so the Fed's preferred inflation gauge, and also the personal income. And for Japan, lastly, this coming Thursday, we have the consumer confidence. So it measures as well the household optimism regarding financial situations and the job market. Plus, we also have the BoJ interest rate decision this coming Friday, and the central bank's announcement on monetary policy expected to steady at 1.0 following prior normalization steps. Plus, we have the United Kingdom, so they have the interest rate decision this coming Thursday as well. So the UK Central Bank's policy choice and widely anticipated to hold at 3.75%. So speaking of the interest rate, so what kind of inflation is happening right now? So we are understanding the US price trends. So if you have been watching the markets or tracking macroeconomic data, you know that understanding the current price pressures is very critical. So how do the economists actually classify what is happening right now? So in macroeconomic terms, the current phase of US inflation is really hovering above the Fed's long-term target. And while responding to lingering supply chain dynamics and also the energy fluctuations, and also the sticky service sector cost is best described and analyzed through these specific economic concepts. So first, let's take a look on the inflation. So sticky price. So rather than there is a wild or a runaway hyperinflationary spiral, so the current environment right now is characterized by components that simply refuse to budge quickly. So economists use them or this term to describe parts of the CI, for example, or the consumer price index that change price very slowly. So just think about the shelter costs, medical services, and also the certain transportation sectors. So even as headline numbers, they fluctuate due to the volatile sectors like energy. So these sticky elements maintain a structural floor and under core inflation metrics. Next, we have the directional trend, which is the disinflation. So when looking at that trajectory from the multi-decade peaks of the post-pandemic era down to the current readings, so the correct economic term for this overarching trend is disinflation. So to clear up any confusion, inflation is the general rise in prices, whereas disinflation is a slowdown in the rate of the inflation. So prices are still rising, but they are doing so at a progressively lower percentage rate compared to the previous periods. You can check as well the data from the inflation rate. At the same time, let's look at the root cause of these cost push pressures. So from a causative standpoint, much of the persistent pressure has elements of cost push inflation. So this occurs when overall prices increase due to surge in the costs of wages and raw materials. That's why from time to time we track the labor employment, the non-farm payroll reports, plus at the same time the manufacturing and production. So they are as a structural energy supply shocks as well, or geopolitical disruptions affecting the oil and also the transit corridors, rather than purely from excessive consumer demand, which would be demand-full inflation. Now, to summarize in our market outlook, so if you are looking for a precise label for that economic environment, we see that this is typically classified as a period of sticky, moderating disinflation driven by persistent cost push factors. So for traders and investors, this means central banks must continue carefully navigating for a higher for longer monetary stance to root out remaining pricing momentum. Now, how the war, gold, and the strong dollar drive today's sticky inflation. So when this geopolitical stress collides with the central bank policy, so global financial markets, they could really feel the shock. And you can see the wave on the indices, like the stocks, the commodities, and even the cryptocurrencies and the pairs of the currencies. Now, today, we are tying together the macroeconomic environment of this persistent sticky inflation, shifting to the Fed rate expectations and geopolitical risk. Because back then, again, as I mentioned a couple of times, what the markets were always anticipating is slashing of the rates, or at least maintain that specific rate. But right now, including this geopolitical risk plus the sticky inflation, these are the factors right now that we need to stick or to include in our variables or to incorporate with our models. Now, to make sure or to make sense at all, we will break down of the cause of war, so gold price behavior, the DXY or the US dollar index trend, and also map these mechanics directly into a theoretical called the ISLM macroeconomic framework. So let me show you as well a guide for this one. So here, this is a summary. Let's take a look first on the data. So here are what we are tracking right now this week are the highlights. Now, the cause of war and geopolitical supply shocks. You can see the WTI, for example, or particularly this one, the gold. So let's take a look on the energy complex. So escalating geopolitical conflicts such as disruptions in the critical transit like the Strait of Hormuz, they would really create immediate structural energy supply shocks. And the economic toll is clear, surging crude oil prices, pushing back to between 85 to 90 range. So it drives up as well the manufacturing, in transportation, and also the raw material expenses. And another thing is that it also affects our commodities or agricultural because of the fertilizers. So this feeds as well directly into the cost push inflation. So forcing as well the central banks to maintain highly restrictive policy stances even when broader demands show signs of cooling. So let's take a sample of the gold price fluctuations as well. How is gold reacting? So precious metals are reflecting as well the chaos. So gold has sustained a structural bid. So trading around to 4,050 to 4,200 per ounce. So it also underpinned by persistent geopolitical safe haven demand and central bank reserve diversification. However, there is a macro push and pull here. While there is a safe haven flows that provide a strong floor, rising real yields, and also a resilient US dollar, it creates as well an intermittent headwinds and also capping aggressive rallies and upside rallies, and also driving also a choppy consolidation phases. So here we have the DXY. So the trend, what about this one? So right now it's on the 101 level. So the US dollar index, it generally as well has consolidated in a range between 100 to 102 level. So the drivers behind this are twofold. The dollar benefits from a war premium safety bid. Alongside, there is a shifting as well market expectations toward a potential Federal Reserve tightening cycle, or also an extended higher for longer pause under the new chair. So this dynamic offsets as well softer domestic data prints and also keeps the currency supported relative to its major peers. Now, here we can see as well how to model how a cost push inflation shock and also a higher for longer monetary stance interact theoretically. So we need to turn to the ISLM framework, which is modified for supply shocks or supply side shocks, and interest rate rules. We have to note from time to time these supply side shocks, particularly when you're looking on commodities like the WTI. So again, we also take a look as well on the OPEC. So this shows as well how markets connect. So it visually demonstrates as well how a change in one area like the central bank hiking interest rates, plus there is a ripples through affect business investment, consumer spending, and also the total economic output like the GDP or the aggregate output. Plus, at the same time, it also explains the short run fluctuations. So it is one of the best tools as well for understanding how economic shocks such as sudden energy spikes or shifts in government spending, be it on the fiscal or likely right now on the war, so impact growth and inflation in the short to medium term. Now, it also guides monetary and fiscal policy. So policymakers use the framework to see how combining government budgets or the fiscal policy, so with interest rate decisions and the monetary policy that will stabilize or destabilize the economy. So why is this important? In short, while day traders might rely on technicals like the RSI, for example, this one, RSI, Bollinger Bands. So for traders, particularly if you're looking or relying on the fundamentals, so macro traders rely on ISLM curve or the logic behind this to understand of this overarching why behind the major multi-week or multi-month trends. So it would also suffice the report that why do we expect, for example, for the gold to see this on a long-term trend to go on an uptrend. So again, so let's take a look now for this one. So the IS curve, of course, we take a look on the good market equilibrium. So just to have this a summary of our report, so this is the total output, the Y, and equals to the aggregate demand, CI plus G and plus NX. So here the real interest rate is expressed here with R, which is the rate, plus here the cost push shocks reduce consumer purchasing power and also shift investment downward, contracting the IS curve to the left. And the LM curve, central bank rule, or rather than a fixed money supply. So modern models use a reaction function when the real interest rate responds to inflation. So because inflation remains stubbornly high due to energy shocks, so the central bank keeps the policy rate elevated. So these are the models that are being used to factor in when it comes to what are we projecting over the next half of 2026. We have this database, and that's how we compute or project the prices. And this explains the market equilibrium. At the same time, in general equilibrium interaction, so in the ISLM plane in economics, so this maps to a leftward shift of the IS curve from energy shocks combined with the contractionary monetary stance, So the result is always subdued economic growth coupled with elevated interest rates and a resilient currency. So again, having this just an example, today's economy, it really faces right now, from time to time, you can see the inflation data, it's really on a stubborn trend. And it always being driven by supply issues and high costs, particularly on the energy. And because of this, central banks must keep interest rates high while dealing with ongoing global uncertainties. Now, to conclude, understanding these moving parts is really essential for navigating today's asset allocation and also in terms of currency strategies. So for example, here we are looking at the Bank of England. So what to expect for the BoE interest rate decision this week. So of course, what to expect as commodity as well shocks or reshape the UK policy. So as central banks, they navigate on unforgiving macro landscape. So it is defined by volatile commodities and stubborn price stickiness. And attention would shift squarely to the treadmill street. So this week, the BoE monetary policy releases its critical interest rate decision. So with the base rate, which is around 3.75, we examine the market forecast, the impact of renewed geopolitical energy shocks, and the ripple effects across United Kingdom assets and their domestic economy. So again, market expectations. So this is a example as the extended plateau. So consensus or forecast falling and money market pricing point it would also overwhelm toward a steady hand from the MPC. Now the headline, so the verdict, of course, economists across major surveys, they anticipate that the bank rate will remain unchanged at 3.75%. So here, the division here of voting or within the watch for a split vote, so it's projected around 7-2, with a hawkish minority expected to advocate for tighter policy to fend off second round price pressures. Plus, we also have the disappearing easing hopes. So the narrative is of an imminent smooth rate cut cycle for the BoE. It has also vanished. Again, smooth rate cut cycle, it has already vanished. So markets, they have completely priced out near-term cuts and replacing them with a prolonged higher for longer plateau stretching deep into the late 2026. So again, having this, when you are projecting your currencies, for example, expect 3.75, it might be maintained up to this late 2026 or stretching on the first quarter of 2027 if there would be only big catalyst for the BoE to slash it. So the sudden pivot away here from policy easing that stems directly as well from severe strains in the global energy complex. We have the energy shock factor. So we have the crude rebound on geopolitical tensions and also from severe strains at the same time the UK headline inflation drifting near 2.6, and also we call it as a cost push transmission and the return of hike risk. So rather than arguing over the timing of future rate cuts, so again, analysts are increasingly as well warning that the sustained energy spikes, it could really force the BoE to evaluate additional rate hikes later this year to keep the inflation expectations really anchored. Now, fallout for sterling, the gilts, and the mortgages. So we expect as well. So the Forex, like the GBP, so the British pound finds itself in a cross current. So while a steady hawkish BoE offers yield advantage over dovish central banks, so safe haven capital flows in the US dollar continue to limit upside gains. And for the UK gilts and fixed income short-term gilts, so it remain as well high as investors as well price out monetary easing and pushing term premiums upward across the sovereign curve. Plus, we have the mortgage holders and the real estate borrowers. So they're hoping right now for a relief on tracker or variable rate cuts products that will be disappointed. So high street lenders have fully integrated already these elevated funding realities and signals as well that restrictive credit conditions might stay. So to conclude, this week's BoE gathering, it is far less about the headline rate and entirely about the tone of forward guidance. As the MPC weighs sluggish domestic growth against imported energy shocks, so it's also messaging it will determine whether markets stay parked as well in extended pause or brace for a surprise tightening cycle. So with three major bank decisions, the Fed, the BoE this week, and the BoJ, so they are converging alongside heavy global macroeconomic data and the earnings release, and certain asset classes present right now a strong trading opportunities due to heightened volatility and clear directional catalysts. So for Forex majors, assets to watch here is we have the GBP and USD and the USD JPY. So why it's an opportunity to trade, because GBP USD or the sterling over the greenback, it navigates a defined technical range from 1.3150 to 1.37 flat, while the BoE prepares its rate decision. So Range bound traders as well can look for fades near technical boundaries, and especially in the United Kingdom labor and inflation data that could really create sharp intraday cross currents. Plus, the USD JPY, again, it continues to be driven by stark interest rate differential and also the monetary policy divergence between the Fed and the BoJ ahead of the meeting from the BoJ, and pullbacks toward support continue to attract buyers looking to capitalize on yield-driven trends. For the commodities, we need to, the key assets to monitor, just for the gold, we have the XAU USD, this one. So again, why it's a good opportunity to take a look at the within the week. So trading around the 4,000 to 4,200 level, consolidation region, because it is caught between safe haven support and also headwinds of the higher for longer Fed. So it offers as well high frequency swing trading opportunities around key support of this 4,000 flat or 4 flat and resistance of 4,200 flat levels ahead of the FOMC statement. So crude oil remains, they remain sensitive to Middle East headlines and supply corridors. So any unexpected developments within these stocks or through stocks, it could also trigger rapid momentum plays in energy futures. You can see as well today with the headlines how the markets, particularly the oil, drop due to the ongoing negotiations with Iran. Now, for the developed market or fixed income like the sovereign bonds, we also look on the US Treasuries for the short end and UK gilts. So yields are extremely reactive to incoming central bank forward guidance. So if the Fed or the Bank of England, they lean harder into a hawkish tone to combat sticky cost inflation, so short-term yields will spike, and making as well the rate-sensitive bond instruments or treasury futures that would prime vehicles for volatility plays. And also we have lastly the global indices. So assets or key assets to monitor this week, we have the S&P 500 or we have the Nasdaq as well. So why it's having a good opportunity this week despite there is a high market volatility. So equities are really digesting a mix of high-profile corporate earnings and also shifting macroeconomic rate expectations. So this is a big combination right now, particularly when you are looking on the indices. So tech and growth sectors, they remain sensitive to discount rate adjustments and making as well the major indices ideal for breakout or hedging strategies for following the Fed's rate decision and press conference. So again, those are the markets, key assets to watch this week, opportunities to take a look at. So for Forex, again, we have the GBP over the US dollar and the USD JPY. For the commodities, we have the XAU USD and the WTI or Brent crude. For the fixed income, we have US Treasuries and the UK gilts. For the global indices, we have the S&P 500 and the Nasdaq 100. Next, let's take a look as well about the gold. So gold prices, it climbed about 1% to near 4,100 an ounce as a pause in fighting between the US and Iran, reduced supplies, oil's risk, and at the same time, inflationary pressures. Plus, this easing of geopolitical tensions, it also helped to counteract the recent hike expectations from the Fed, but also had previously pressured the precious metal. Another thing is we have from the oil. So global financial markets as well, it rallied with oil prices dropping and bonds as well advancing. So as the US and Iran pause hostilities, we see investors prepared for the Fed interest rate decision that would be this week and a heavy slate of major technology earnings. Another is we have update from the DeepSeek. So again, DeepSeek has suspended its second fundraising round after the founder Liang Wenfeng grew frustrated by viral online reports concerning his past comments on US-China AI competition and chip reliance. So despite halting this financing deal, the AI pioneer is still considering resuming talks later and has already started preparations for a potential IPO this year. Another is we have the chip maker CXMT. So again, the Chinese memory chip maker saw its shares surge 472 during its debut on the Shanghai Stock Exchange, and after raising 9.8 billion in China's second largest IPO in history. So the blockbuster listing as well, it highlights Beijing's push for technological self-reliance and capitalizes on soaring global demand for AI hardware. Now, to have an update on the OPEC, so last week, we have the weekly. So it ended to 92.97 for the weekly basket price. Now, let's take a look on the pair that we are going to discuss today. So we have the Euro USD. You can see as well, this is based from the 4-hour chart. So this pair, the Euro USD, is recovering slightly from last week's drop and also holding above this 1.13 level. So again, I have these supports 1.13778 and 1.3893. And for the resistance, 1.14739 and 1.1506. So I have a big range that I provided here based on different time frames. I have 1 hour and 2 hour for chart and daily, plus at the same time the weekly chart. Now, why different time frames I'm looking in terms of the modal value and how many times it was touched or the frequency? It's because we have the FOMC rate decision. Plus, we also have high impact data. And at the same time, due to this ongoing geopolitical risk, that is really causing energy costs to push higher. Because again, the markets are very sensitive right now to these headlines from the Middle East or from the Persian Gulf. Now, the FOMC rate decision is one of the key economic drivers for the pair. So rates are expected to stay unchanged, but markets will closely listen to the Fed. So a cautious or hawkish tone could push the dollar and at the same time pull the Euro USD down. Now, another is the second quarter GDP. So again, we also look on the data that will dictate as well the risk sentiment. So stronger growth favors as well the dollar, while a weak reading, it gives as well the euro room to breathe. Now, for the durable goods and the PCE inflation, so midweek reports checking consumer health and manufacturing. So PCE inflation data will give final clues on the US price pressures. Another thing we look is on the strong earnings reports that will be coming from the major tech giants that are dragging the US indices. Of course, strong earnings would also boost the DXY or the US dollar index. And at the same time, we look as well on the Eurozone preliminary GDP. So on the European front as well, the flash of the GDP growth rate will measure as well regional economic health against lingering energy headwinds, which would directly impact the confidence in the Eurodollar. Plus, again, the ECB policy pricing and the September rate expectation. So, following the recent policy pause, so swap markets have already priced in. So, again, of a 25 basis point rate hike from the ECB at its September 10 meeting. So, because this outcome is largely baked in right now, incoming Eurozone data, it must surprise significantly to provide new upside traction for a single currency. Now, in terms of the energy and commodity prices, so ongoing sensitivity in the global energy, it would particularly crude oil price fluctuations and broader supply pressures. So it would continue as well to impact trade balances and also the relative growth outlooks between the energy importing Eurozone and at the same time, we look on the United States. So again, technical indicators. So after failing near 1.1482, the pair pulled back to find a floor around this 1.13 level. So this is the lowest, again, 1.13778. And the next would be 1.3893. So the pair, you can see here, let's take a look on the daily chart. it's loaded here that showing there's a market movement from late May through late July as well, alongside these Bollinger Bands and at the same time the RSI indicator. So the macro trend here, the chart displays there is a sustained downward trend originating from peaks of 1.70 here last May, and of course driving the market quotes down to 1.30 support level by the month of June. Now, for the recent consolidation, since hitting those lows, the market already has entered a recovery and consolidation phase. So trading mostly sideways between 1.1360 level as well and 1.50 region over the last few weeks. So again, there are resistance one here 1.14739 and the second is 1.15016. This is the trading range I'm looking within the week. From next is the first support would be 1.3893 and the second would be 1.3778. And the last of the the third support would be 1.1360. So it highlights as well the outer, you can see the blue Bollinger Bands indicator, and also dropping as well down to focus on the RSI here. So again, with the reading, it's really lower. So Bollinger Bands, you can notice as well here that it's really near in the middle moving. So here on the average band, so it also have the upper band tracking to this level of around 1.14 to 16, and at the same time near 1.1351. So the narrow bands here, you can see it's compared to the volatile during the sell-off in the month of June. So it signals as well a contraction in volatility. Again, looking down here at the RSI, so it sits there and leaning close to oversold threshold of 30 earlier, and at the same time it persists to go up, suggesting there is also underlying pressure in the short term. Now, current market level, we can see the pair at 1.14 level or 1.4013 right now. So it's near active horizontal support zones. And to wrap things up, we can see that the pair is maintaining a cautious consolidation pattern following its mid-year slide. So that's our basis for the Euro USD pair right now because of our anticipation of the FOMC. So with the RSI here, and we see an active risk management levels here that traders should really monitor key technical boundaries closely for a confirm breakout direction. You can also use as well the volume to confirm once it hits as well the outer of the bands of the Bollinger Bands to see where it's going to trend, particularly if you are mostly focusing on a lower time frame. But however, because I'm looking at range for within a week, I use the daily, weekly, and other lower time frames, and these are the prices that I have plotted. So again, the current trend for this pair reflects there's a cautious consolidation pattern. So it's near the 1.1400 support region. So it's influenced by lingering downward pressure and at the same time energy supply concerns. Again, once we see spikes on energy costs, expect this would have a different trend, providing right now we are expecting this one at least to hit or break this 1.14739 this week. But again, because of the geopolitical risk, we need to look on our pair reacting from the tension from the Middle East plus the US heavy data. So again, that's it for today. Any questions relevant to our market highlights for the week? Okay. Now, if you want to join, so just scan the code and register as well for our dashboard and start tracking our markets. And you can join our Discord, our channel. The link is on the description box below. And I would also reply as soon as. And you can also check our copy trading. So here, head over to this website. So tradingcup.com, you can also mirror their strategies or copy their strategies directly while keeping this technical analysis less complicated or very straightforward and easier to understand. So again, markets are moving fast. Stick to the plan. Let's secure our lead and make it happen. So again, thank you for joining, and I hope today's session provided with you with insights across the markets, highlighting this week, particularly what are key assets to watch within this week as a good opportunity to trade. Have no fear, Ira is here, all is well, and thank you for watching. See you tomorrow on the next session.